What we believe is just because a market is overvalued doesn't mean it needs to fall. But we are in a situation where clearly large cap overvaluation had got corrected with the rampant selling by FIs between September end and February, that the extent of overvaluation had become almost very, very small. To make mega money, you need very cheap valuations and you need fear. You neither have cheap valuations nor do you have extreme fear. So you can't make mega money. Started investing in 1989. So 89 to 94 was one of the biggest bull markets in Indian capital market history. So it is like 2020 to 24. I was under the impression that markets will always give you big returns. It didn't give from 94 to 2004. 94 to 2004, for almost 9 years, then the markets gave zero returns. I'm going to put 30% of my money in one stock or one mutual fund scheme. And what Warren Buffett did in the first 15 years of his life was actually create one of the most concentrated portfolios in his personal portfolio. He didn't believe in diversification, because if you create an over-diversified portfolio, you will not get anything better than market returns. You can get lower than market returns also sometimes. What we have seen is that you have to be very careful in leveraged companies. So if you're buying a contrarian company and you buy a leveraged company, the company can go bankrupt before the cycle improves. Most of the investment gurus say it's wise to avoid IPOs. Can I avoid it in ICICI mutual fund when I'm investing for others? No. We have large amount of money. IPOs gives us a lot of opportunity to look at investing large sums of money. So we do look at IPOs. But as such, if you ask me, we do look at them, but we always think of this, that the seller knows more than us. So the problem at this point of time is, one of the lessons that I learned between 1994 and 97 is, as the bull market becomes mature, I call it QLC, you have to do. You have to improve the quality of your portfolio. You have to improve the liquidity of your portfolio. And you have to increase the capitalization of the portfolio. And I was surprised to see that in 2024, most people did the reverse. They reduced their quality they reduced the liquidity of the portfolio by buying unlisted stocks, and reduce the capitalization of their portfolio by buying micro caps and unlisted stocks and small caps and mid caps. As the bull market matures, you have to do QLC. And at the bottom of the market, what you have to do? You have to do the inverse, which means buy micro cap, buy liquid stocks, and even if you buy, sometimes you buy weaker companies in many sectors. From there, they turn out to be multi-baggers. Suppose you buy the weakest metal company in 2002 at the bottom of the metal cycle. You actually make much more money in that stock than buying one of the best metal companies. Finally, the goal of investing is to make money. And, equity markets sometimes can give you returns too fast, and then you can lose the money. So people just forget the notion of selling. I told them one of the things you can do now is sell your stock and actually enjoy your life.
There has been a lot of talk around tariffs, and markets globally as well as in India have been spooked by them. Do you think that pressure or that fear is now dying down? Or do you think Indian investors particularly are focusing on businesses and companies that are more inward looking, driven by consumption in India, as opposed to, businesses that are outward looking and relying on exports?
I don't think a market knows what is going to happen to tariffs. What I think the market realizes is that you can't have only US markets going up and US dollar going up all the time. We have a situation, I don't think, where we can say that we are through with all the problems or tariffs. We don't even know what US government policy is going to be over the next 2 to 3 years. Having said that, it doesn't mean that all the time only US markets have to go up and US dollar has to go up. Other markets can also go up. I think we have a situation where if you look at valuations, large caps are not meaningfully overvalued. Small and mid caps are overvalued significantly. That doesn't mean that neither of anything needs to fall. Like I tell people, does it mean that Lutyens Delhi real estate is going to fall? Or Palace Orchards, Bangalore real estate is going to fall? Or let's say Malabar Hill, India, Bombay real estate is going to fall? It doesn't need to fall. So what we believe is just because a market is overvalued doesn't mean it needs to fall. But we are in a situation where clearly large cap overvaluation had got corrected with the rampant selling by FIs between September end and February, that the extent of overvaluation had become almost very, very small. But markets are complex things. How they will play over the next few years is not clear. So I go by what Howard Marks says. What Howard Marks says is that you have to think, what are you trying to do? Do you think you're going to make mega money from here? Are you going to try to prevent loss of money from here? I believe we are in a situation where you can make moderate money over the long term from here. You can't make mega money. To make mega money, you need very cheap valuations and you need fear. You neither have cheap valuations nor do you have extreme fear. So you can't make mega money. On the other hand, you have slightly above average valuations and a little bit of fear. So with this kind of an environment, you can make moderate return in the long run. That is what is clear. So you, at various points of time, if you are an investor, you have to decide whether what is it you're trying to aim. Are you trying to protect capital? Are you trying to make mega money? In 2020, that was a year you had to actually try to make mega money.
Yes.
Why you had to try to make mega money? You had extreme fear and valuations were low. So when you have extreme fear and valuations low, you should actually try to make mega money. If you have greed and valuations very high, like September 2024, what you have to do is you have to try to protect capital. So this is what Howard Marks has taught me by his readings, and this is what I try to share with investors.
But what you say may also be construed as, disappointing for a lot of young investors who've gotten into the markets post 2020 because they have assumed that markets means quick gains. What you're saying is that we should be looking at very moderate gains, and that too in the longer term. So is there a reframing of mindset required when it comes to retail investing?
So I'll give you my personal experience. I started investing in 1989. So 89 to 94 was one of the biggest bull markets in Indian capital market history. So it is like 2020 to 24. I was under the impression that markets will always give you big returns. It didn't give from 94 to 2004. 94 to 2004, for almost 9 years, then the markets gave zero returns. So just because you want the market to give big returns doesn't mean that the market is going to give you big returns. And the difference only between then and now is that Indian macro is not a problem. And you don't have a macroeconomic problem. You don't have a fundamental problem in the Indian economy at this point of time. So maybe you won't get no returns. So you get moderate returns. But the environment, after 4-5 years of mega returns, if you think always markets are going to give you mega returns, then equity market is not for you. You lose money. Like what many of us did in 94 to 98. In 1994 to 98 was one of the worst periods in market history. I believe that if investors think that equity market is always going to give you mega returns, then they are completely mistaken. They have not seen markets. It means that they have wrong assumptions of equity markets. Then I don't know what they should be doing today. But that doesn't mean in the near term, again, they can't make mega money. It's possible. But in the long run, you can't make mega money all the time. That has never happened. Certainly, it's happened in US in 90s. But after that, do you know, between 2000 and 2012, US Nasdaq gave zero return virtually. So mega money can't be made in the long run. Mega money can be made in shorter periods of time. And if too much money is made, then you can have a period of subpar returns.
So, sort of taking off, on what you said about India's economic performance, and we seem to be doing well when compared to other large economies. But do you see a comparison here with, say, Japan, where the returns when it came to investments were negligible for almost 3 decades? And then there's China, which also saw good progress economically since 2008. But again, market returns were negligible. So are you putting India in that bracket as well? No.
Not at all.
Okay.
Not at all. See, Japan first had a bubble of enormous proportion. Then they had growth slowing down and the demographics were completely different. So I don't think it's anything like that. If you look at China, it was a country where, the return on equity on most businesses came down significantly. And the government actually withdrew a lot of many of the IPOs that were supposed to happen, etc. So I don't think we are anywhere in that. See, the challenge at this point of time is that when you are managing public money and when there is a breed of investors who come up after 2020, they all expect very high returns and they think that equity market is an easy place to make money. That is not always the case. There are going to be periods of low returns. There are going to be periods of moderate returns. There can be periods of high returns. There can be periods of negative returns. So everything comes as a package in equity markets. Unfortunately, the 2020 to 24 period was a period where you had only high returns. That is a challenge, and it's difficult for me to explain to people that you're not going to have only that. You're going to have all low, medium, high, negative, right. All four. And in the near term, frankly, markets can't be predicted. Of course, I know there are technical analysts who can predict what will happen to the market in the next 1 week, and finfluencers who also think they know what will happen to the market. The reality is no one knows what will happen to the market, because today, can you predict what is going to be US government policy towards tariffs? In India, the answer is no. I don't think most companies in India know that. So when we meet Indian companies, they say they don't know what is going to happen to tariffs. So how can you predict stock prices in the short run? So in the short run, I think stock prices are very difficult to predict. But on the other hand, it's important to know when the markets are very cheap. Equity markets are very, very good to invest, like 2020. So people who started in 2020 have done the right thing by getting into equity markets. But not always markets are like 2020 when they are cheap and fearful. That's a fantastic combination. But you don't get it always. If you get it like 2008-9, 2020, 2002, the 1993. These are all superb opportunities, but not always you're going to get both.
So there is anxiety now, right, after what happened post September. And you mentioned that there are young investors who are keen and who've thought that, you get into the market, you make mega returns. While they're changing their mindset, how can you sort of help them out here? Because, you have seen so many market cycles, you have seen so much ambiguity. So what are some of the key lessons that you now apply when you see that, again, investors are, getting anxious, getting impatient?
I think there is a need to create a journal. I tell people when you go and buy a car, or you go, let's say you buy even a two-wheeler, you would go and ask any of the earlier owners of that two-wheeler whether you like that two-wheeler, or what are the problems you saw in that two-wheeler, or what are the problem you had in that car. With a similar approach, I think whatever portfolio you have created at this point of time, you have to ask yourself what is there in that portfolio. And the time to do it is today. What many people have done, and I've seen it done, they do it at the bottom of a market and try to look at what is there in their portfolio at the bottom of the market. That's not the time to look at it. Today is the time to ask yourself, why did I buy a stock? Is there a rationale to hold that stock? So create a journal. And first try to create that journal. Then you will realize out of X number of stocks and Y number of mutual funds, you would know what is it you are holding with logic. Then concentrate into the ones where you think you have a logic to invest. And that way you can actually restructure your portfolio into something which you believe in. If you have stocks that you believe in, then you will think about it in a long-term way. And then you will be able to ride out any market. So that is one thing I would say.
That's a fantastic idea. Journaling for better investing. I think that's a great idea. But, sir, when we look at valuations, and you've spoken about them, in fact, before I get to valuations, I do want to talk about the concept of buying, sizing, and selling. Yeah. You've spoken about how people tend to focus on the buying aspect. How important is sizing and knowing when to sell? And what can retail investors work on when it comes to those aspects?
Oh, sizing is extremely important. In the first 10 years of what I saw is investing, I used to tell that what most people I knew and whomsoever I used to work with in my investing career, we created what we call a zoo. Why I call it a zoo is you buy so many stocks. So what you do is essentially you have created a zoo. You have not created a portfolio also. So if you want returns in the market, you have to take meaningful positions in a few stocks or in a few funds, in a few mutual funds that you know, and you have a rationale why you have bought that mutual fund or why you have bought that stock. So what I've seen is people don't size. So what we learned after a decade, if you have to make money, you have to invest meaningful amount of money in one or two things. It is just like suppose you were to study for an exam. If you don't prepare very, very well, you're not going to do well. Something like that, you have to size and say, I'm going to put 30% of my money in one stock or one mutual fund scheme. And what Warren Buffett did in the first 15 years of his life was actually create one of the most concentrated portfolios in his personal portfolio. He didn't believe in diversification. Because if you create an over diversified portfolio, you will not get anything better than market returns. You can get lower than market returns also sometimes. So you have to do the sizing. The selling part of it, you learn later. What happens is finally the goal of investing is to make money. And equity markets sometimes can give you returns too fast and then you can lose the money. So people just forget the notion of selling. And they don't realize that if you had bought in 1989 and sold in 94, bought in 97 or something and sold in 2000, you made mega money. So there are times when I tell, and I did this in an event in Chennai about 6 months back. I told them one of the things you can do now is sell your stock and actually enjoy your life. Because I said that, because the reality at this point of time is that people forget to sell. And again, it is out of greed because they realize that they are making money. They are making money by waiting, holding. But there are times, at some points of time, you have to decide you have to sell. But no one teaches you to size or sell. Frankly, when you concentrate, you will realize that you will do better work. You will do the whole journaling process much better. Whereas if you create a zoo, you'll talk to each friend and buy a share. Then it's a zoo. Then you won't do the work. Whereas if you put 30% of your net worth in one company, you obviously, or in one fund, you'll obviously try to do much better work and see whether you're making a logical decision or not.
Yeah. So, you mentioned Warren Buffett, but you seem to have a contrarian view there as well, because you are such a champion for asset allocation and diversification of portfolios. And people always ask this question again and again, that what is the correct asset mix for me? How does one decide that?
So diversification of portfolio, actually, what is the way I define asset allocation is buying the most undervalued asset at this point of time is what I deem as asset allocation in a way.
Okay.
Now, asset allocation in a period like 2024, when people believed only in equity, was to get them to buy all the other assets. It could be debt, it could be gold, it could be REIT, it could be InvIT, it could be global investing like investing in China or Europe. So that for me was asset allocation. Asset allocation is diversification into asset classes which have done badly. But you have to remember that at a point of time, asset allocation works all the time. But asset allocation involves investing in the most undervalued and hated asset class at a point of time. So, although I am not involved in office assets at any point of time, I tell people office is the only asset in India which gives you yield. Equities don't give you yield. Residential real estate doesn't give you yield. Offices give you yield in India. So I tell people, if you have the money to be able to invest in an office asset which can give you yield, it is one of the assets which really gives you yield even today in India. So, and office assets haven't done very well in the last 5 years compared to residential. So, in asset allocation is actually, in a way, concentrating and sizing an investment in an asset class which has done badly. 2 years back, when we popularized multi-asset as an asset class, at that time it involved investing in gold. In my wildest dream, I did not believe that gold will do so well in the last 2 years. And today, I don't think asset allocation would mean investing big amount of money in gold. It isn't in our framework because gold is at all-time high. So you have to be much more cautious in gold at this point of time because gold has done very, very well compared to everything else. That is how we look at it. Whereas if you were to be a person who had looked at something like China or Europe last year, it would certainly be looking at it. Whereas today, if you look at it, US dollar or NASDAQ is one of the most overvalued assets. So asset allocation would mean taking out money from NASDAQ because it has been one of the best performing asset classes in the world.
But for example, you said gold has done incredibly well. So then do we take out money from gold right now? Do we do that? Because the valuation, again, coming back to that concept.
It depends on the way you have invested in. If you have invested in through a gold ETF, certainly it is time to actually think about it. If you have invested it in through a silver ETF, certainly you should consider taking out money because those are all places where you put 100% of your money in a single asset. The gold is possibly the best performing asset class over anything in India at this point of time.
Yes. So, you've also mentioned that ETFs and index funds are probably the right way to invest for the future. But then why would people invest in active mutual funds if, that is the view?
No, actually what we have done, we believe that, the lower the cost of investing, the better it is in the long run. So what we have done is we have actually packaged some of the ETFs into a fund of fund structure and said that that is possibly a very, very efficient way to invest in a low cost way of investing. And I think active investing in a developing country like India and an emerging country like India always works, has a chance to work. Because in India, you have what I call cyclical corporate governance. There are times when companies are working in the interest of the minority shareholder. There are times when companies don't work in the interest of the minority shareholder. So, when you're an active investor, you actually at times identify companies where you avoid some of the companies. If you look at the 2017-18 period, many of the non-banking financial companies and private banks like Yes Bank, they were all avoided because of the fact that, you knew that there was certain risks lurking. And that is something which works out of active management. So active management works much better in a country like India or China. In China, as you know, many of the companies which showed profits, finally they found out there was no profit in them. So that's why I would believe that active management has its own role in such countries.
Okay, so let's talk about the tricky topic of valuations. Right now, you have mentioned repeatedly that stocks in India right now are overvalued, whether you talk about large caps or small and mid caps. Do you think that froth still exists even after the corrections we have seen?
I think I mentioned in large caps, the overvaluation is not significant. It is there, but it is nothing much to talk about. So one of the things in this entire cycle at this point of time is that all the money is being raised by corporates from investors. The private equity investors are also selling stocks to Indian domestic investors. So what is happening at this point of time is the risks most of the risks are being taken by equity investors at this point of time. And therefore, somewhere there is an overvaluation in small cap and mid cap. Obviously, there will be some stocks in small cap and mid cap which are not costly also. But essentially, the risk taking is happening at the investor level now. But I would not say that the large caps are overvalued. If at all, they could be marginally overvalued. There have been sectors like banking and finance which were not overvalued, which is one of the reasons in the last 6 months, both banking and finance and metals were the two sectors which are not looking overvalued, and both of them have actually not fallen in the last 6 months.
So, what are the ways an investor can actually assess value? That's the other question to ask.
See, actually, what we do is we see the simple way to do it is price to earnings, price to book, and market cap. These are the simple ways. Now, people will ask me, if you follow this approach, you will miss companies like the IT companies in 99, 2000. If you were in US, you would have missed Google, Amazon, those kind of companies. That is true. So if you are a very good growth investor, what would happen in this whole process is that end of the day, you will miss some of these. You and you have the capability to look at these growth companies. Then you don't look at valuations. But out of 100 investors in India, maybe 98 don't have the ability to identify good growth investing. But for all the other people, using simple investing like price to earnings, price to book, market cap works. That would have allowed you to invest in 2020. It would have allowed you to invest in 2008 after Lehman failed. It would have allowed you to invest in 2002. But you would have never managed to invest in Tesla.
So you've spoken, right now also about extreme value, extreme market valuations. You've advocated maintaining cash also. So when we look at a fund like the ICICI Prudential Flexi Cap Fund, in Q3 FY25, it was 98.5% invested. So what was the logic there? Why was the fund not more aggressively positioned in cash?
See, actually, at ICICI Prudential, we have multiple fund managers, and I am the chief investment officer of ICICI Prudential. I don't run all the funds. So I have a colleague who wants to be fully invested all the time. So, and he actually runs a very growth-oriented portfolio. If you look at his portfolio, you'll find that it is very, very growth oriented. And he does not believe either in value investing or in contrarian investing. So he has a different style. And at ICICI Prudential, we believe we should not have the entire AMC run on only one style. So he has that style and he runs it that way.
Okay. So you're saying that there is freedom for fund managers to
absolutely.
follow their gut.
Absolutely. My colleague Rajat believes in growth investing. He doesn't take cash calls in his fund. And you'll see, as a rule, he has not taken cash call in his funds.
We will talk about cash calls in a bit. But whether it is this fund or the other funds at ICICI Prudential, what is the guidance on maintaining balance between what could be short-term concerns and what could be the long-term strategy?
See, finally, we run funds with a long-term view, and we measure by and large with a 3-year and long-term horizon. And I think it is impossible, as I mentioned earlier, it is impossible to guess what will happen in the short run. If you try to run funds with a short-term view, you can't believe what will happen. And it's much better to actually run funds with a long-term view and measure fund performance also with a long-term view. So I don't think, but at the same time, you should know long-term is a set of short-terms. So, but as such, if you ask me, we always think long-term. So last year, for example, throughout the year in many of the schemes, we cut our small cap and mid cap holding. We did not know when the small and mid caps would correct. Finally, they corrected this year in January, February, but we didn't know when it would correct. So could people have predicted when it would correct? The answer is no. It was not possible. So what we believe is that you have to always take decisions keeping the long term. And what you do is, as what you think will play out in the long term doesn't happen, you keep adding to your position. Actually, the best experience was in 2018 to 21 period. In that period, what happened was we used to bet on metals, we used to bet on PSUs, we used to bet on telecom, etc. We bought, it didn't work. We bought more, it didn't work. We bought more, it didn't work. Finally, in 2020, October onwards, it just worked. By that time, we had accumulated more and more and more of PSUs, more and more of metals and telecom. And we got the benefit of a much higher weightage, which we had accumulated more because it kept on underperforming. And we we wouldn't have known why it started turning in 2020 October. We could have well believed that it should have turned earlier, but it turned earlier. It turned after 2020 October. In fact, it's very interesting that both times, even in 2020, after the US election, a lot of markets changed. At that point of time, many of the quality stocks started to underperform. This time, after the US election, the Indian market saw correction. So, somewhere the US election is a very important equity event, is something you wouldn't realize in India.
Yeah, surely. So, you're known as the most important voice when it comes to contrarian investing. Now, the thing is that people would say that contrarian investing requires guts, right? You're going against the tide. So, what should a retail investor know? The top three things that they should know about a particular script before they go in.
So I think Seth Klarman is supposed to be one of the biggest gurus of contrarian investing. He says that if you have to be contrarian with a calculator. So he says that if you're not a contrarian with a calculator, you're likely to go bankrupt. So if you looked at it in 2008, many of the real estate stocks kept going down. If you chose to buy those real estate stocks, like let's say Unitech, because I'm talking about an old company, you'd have gone, those stocks would have gone to zero. There's so many real estate stocks in that cycle. Those companies don't exist today. So you can't be contrarian for the sake of being contrarian. You have to be contrarian, and then you have to work on the company and be sure that it will do well. So what we have seen is that you have to be very careful in leveraged companies. So if you're buying a contrarian company and you buy a leveraged company, the company can go bankrupt before the cycle improves. So I would say that the most difficult job in contrarian investing is to buy a leveraged company. Actually.
That's a great takeaway. So, please continue.
So I believe what people do is they buy just contrarian without doing the number work. So what Seth Klarman says is be contrarian but do the number work. So if you go buy bad construction companies in the 2010 to 12 cycle, if you buy bad quality NBFCs in 2017-18, you would have lost everything. So you can't be just contrarian for the sake of being contrarian. You have to do your number work. And that number work should sound logical. And you don't need to do extreme number work, but you need to do logical. And sometimes you can say, I won't do contrarian investing in leverage names. But to think about it, what was the logic in 2020? It was very simple actually. We were all sitting at home and working. When you're sitting at home and working, what did we need? We needed telecom, we needed power. So the simple contrarian thinking is power stocks were at record low. But we realized that without power, we still needed power from working from home. Yeah. So the simple contrarian calculation was that if sitting at home and working, I'm able to work because I'm having power, I can buy power stocks at record low valuation. So we were contrarian in power, but we realized that without power, we could not have lived in a COVID world. Yeah. Then how could we communicate between ourselves in a COVID world? It was telecom. So he said telecom was at record low valuation. So we could write in a journal that without telecom, we can't work in a COVID world. So it was very simple. So I believe that sometimes common sense helps, but you have to do this calculation. And if you're going to do blind contrarian investing, I think many stocks will go to zero. And that is our learning of running a contrarian approach over the years.
One of the things that creates a lot of excitement these days in the markets is the number of IPOs that are coming out, right? And for companies, it's great in the sense there's no interest burden; they're getting, money from the public. But what is it that investors need to be very careful about when it comes to IPOs?
See, as a general rule, investors have to be very careful about IPOs. I spent 4 years in investment banking in 90s. And then I've spent 10 years as a stockbroker, then 20 years in fund management. I find that you have to be very careful in IPOs. The person selling the IPO always knows more about the company than you as a buyer. So the seller always knows better here. So which means that you have to be exceptionally careful in IPOs because there is an information asymmetry. The seller knows more, the buyer knows less. So you're well advised. I think even most of the investment gurus say it's wise to avoid IPOs. Can I avoid it in ICICI mutual fund when I'm investing for others? No. We have large amount of money. IPOs gives us a lot of opportunity to look at investing large sums of money. So we do look at IPOs. But as such, if you ask me, we do look at them, but we always think of this that the seller knows more than us.
But that's exactly what I'm asking. So when you choose to go in for an IPO as ICICI Prudential, what are the things that you're factoring in?
So we look at management quality, we look at the business, we look at the valuation, we look at everything. But if you look at the portfolios, for example, that we run, the quantum of money that is remaining in stocks that we have invested in IPOs would be very low because we are always worried about IPOs. And we believe that we have to be conscious of this fact. And over the years, I've seen that in IPOs, it's tough to make money. And that's why, we have many thematic funds, but we don't have an IPO, a thematic fund based on IPO.
Tricky territory.
Tricky territory.
So, one of the biggest dilemmas for most fund managers is that inflows are usually at the highest when markets are at the peak, and lowest when valuations are sometimes very attractive. So, how does one deal with this challenge, especially as a fund manager?
So we went through this debate, when I became a CIO in 2011 February. Uh, myself, and Nimesh and ICICI, we spent a lot of time learning about what went wrong in 2007, 8, 9. This is precisely what went wrong. We got too much money in infrastructure fund. So after that, we realized that if you want to actually create a good investor experience, you need to get money in hybrid funds like balanced advantage category, etc. Where if you get the money, you don't need to invest fully in equity. And ever since that, as a mascot, we have been promoting asset allocation. We've been promoting dynamic asset allocation categories like balanced advantage. We have been promoting categories like multi-asset. We've been promoting categories like asset allocator fund of fund. And the experience has been just absolutely phenomenal. Because essentially these funds, what they did, they bought in 2020 March. In 2020 March, they were the biggest buyers of equity. And the experience of those investors are nothing short of extraordinary because of that fact. Again, if you look at the experience as we speak over the last 6 months, the experience of the investors is far better than what they could have got in any small cap, mid cap, or equity fund. So we really moved to that model, and we have found that investors have responded. And I must thank my sales team, the investors, for actually considering these products, because these products don't give you greed. Because during periods of time when the market shoots up, people say, am I not investing too conservatively? So I must thank investors for choosing these products, because it's not that we have small monies in these products. We have huge monies in these products like balanced advantage category. And I would say that I must thank investors, mutual fund distributors, my sales team, my company for popularizing this category. The entire unhappiness I went through 2007 to 9 has gone away, and I did not believe that we at ICICI could pull this off.
Well, sir, you have, and now there is a great responsibility and expectation from you as well. So I want to understand, how do you manage that? Because your investors are totally reliant on your vision.
No, you look at it, it's so simple. Think about it, what we do in many of these categories. The market falls, we buy. The market goes up, we sell. That's what you want anyone to do. But if you try anyone to try to do it themselves, they will fail because it is too stressful. Imagine in February to buy is so difficult. Because every day market falls in February and you have to buy, and that's what we have done. So I believe that what we are trying to do there is simple common sense, but very tough for people to implement. And that's why I don't think it's such a big responsibility. I think the happiness that we have got at ICICI, that the fact that investors invested in this product is just too much.
So we can't let you go without asking, your thoughts on the sectors that could give good returns to investors in the near term and also in the long term. So what are the sectors that you would be focusing on?
See, I think, over the last 1 year, what I've been telling on is that more than sectors, I think the biggest problem at this point of time is that people are likely to lose money in unlisted stocks. Then they are likely to lose money in micro cap stocks. Then they are likely to lose money in small cap stocks. Then they are likely to lose money in mid cap stocks. I think sectorally, the opportunities or the negative opportunities are lower. But you look at, in early 90s, there were some unlisted stocks which again got sold to a lot of people. And you would not know those unlisted stocks never got listed. So the problem at this point of time is, one of the lessons that I learned between 1994 and 97 is, as the bull market becomes mature, I call it QLC, you have to do. You have to improve the quality of your portfolio. You have to improve the liquidity of your portfolio. And you have to increase the capitalization of the portfolio. And I was surprised to see that in 2024, most people did the reverse. They reduced their quality of the portfolio. They reduced the liquidity of the portfolio by buying unlisted stocks, and reduce the capitalization of their portfolio by buying micro caps and unlisted stocks and small caps and mid caps. As the bull market matures, you have to do QLC. And at the bottom of the market, what you have to do? You have to do the inverse, which means buy micro cap, buy illiquid stocks, and even if you buy, sometimes you buy weaker companies in many sectors. From there, they turn out to be multi-baggers. Suppose you buy the weakest metal company in 2002 at the bottom of the metal cycle. You actually make much more money in that stock than buying one of the best metal companies. So actually, in this framework is what we believe in. And this is based on the learnings that we all learned. Many of us learned in the 90s. So this is the framework that we believe in.
I think it's been such a privilege learning from all your experience today. Some great insights, journaling about what stocks are in your portfolio, why they are there, QLC at a time like this, and also, what you have said about how to assess valuations. All of these are great takeaways for investors. Thank you so much for joining us.
So thank you for the opportunity, and I'm sure all the Groww investors will keep growing.
We hope so. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.